Well, good morning, Bob.
Good morning, Bill. We're back in live color video, right?
That may not be good. That may not be good.
It's been a long time.
Well, I was in Brazil, and then 2 Mondays ago, and last Monday you were in Brazil, and I had to cover the content last Monday all by myself, which was sparring, sparring having content. It wasn't much content. I'll get it out in a minute.
10 minutes of content.
Well, 10 minutes of talking, not much content. So today we're continuing our discussion talking about appraisal regulation and the changes. Last week I discussed the 2010 appraisal and evaluation guidelines and really going back to FIREA passed August the 9th of '89 and the appraisal rules that were implemented subsequent to that, and then bringing those forward about the requirements of an appraisal and appraiser independence, as well as appraisal review requirements, that sort of thing. So you have lots of notes this morning.
Well, when we're talking about new regulations, and obviously the big one right now is that people are all grasping with is the DoddFrank regulations.
Or what's been written so far.
So far, I mean, the DoddFrank legislation is pretty comprehensive. I mean, there's a lot of issues, and so I just wanted to sort of tick off the major points in Dodd-Frank.
Now, is this going to be related to appraisal, or are we going to do the gamut of things, like we're going to do proprietary trading, the whole thing?
The whole thing.
Okay.
You know, but I don't want to go into the details on them, but just to give a scope. They changed the way that the oversight and supervision of financial institutions is done.
Right, exactly. That just by itself, that's a big deal.
That's huge. There's a new resolution solution for large financial companies, the too big to fail things. So I've got a new way of dealing with that.
I like that resolution solution.
Yeah. There's a new agency for consumer financial laws that a lot of our clients are struggling with right now.
The Consumer Financial Protection Bureau.
Right. There are more stringent regulatory capital requirements that people are definitely struggling with.
That's tough.
And that gets to valuations.
It does.
There are stringent regulations on over-the-counter derivatives and how those are.
I thought you were going to say over-the-counter drugs.
No, that's another conversation. That's our 4 o'clock meeting.
That's good. All right.
We've got they reform regulations on credit rating agencies. You know, we've had some less than stellar performance by credit rating agencies over the past several years. And,
that's an understatement.
And so it's good to see that maybe something is going to be done about that. There's changes to corporate governance and executive compensation and how that's managed. The Volcker Rule was just approved last week, and all the regulatory agencies got on board, approved the Volcker Rule. That's a big deal.
And you know, that covered proprietary trading. I thought I knew what proprietary trading was. It's not that clear to me now after reading the regulations exactly what is proprietary trading.
No one knows, and it's all going to be on the interpretation of the regulators and how they choose, because on everything they specifically prohibit, then they also provide an exemption.
Exactly.
And so it's up to the regulators to determine, is this part of the exemption or not? So the banks, they're not real sure.
When I was coming, if you're trading your own book, it's proprietary trading.
Exactly.
However, it's not that clear anymore.
No, not if you're working on yield or something, for a specific thing, and you've got enough capital requirements and this and this and this, and then it's okay.
Exactly.
Not always. It also requires registration of private fund advisors, which is a new thing. And there are going to be major changes in the securitization market. There's a 667-page set of proposed rules that are under review, and that could have some major changes on the AB rule, or regulation AB.
Reg AB or AB2.
And then there are a whole bunch of studies that they've identified that need to be done, and including they've got this new Office of Financial Research. Sounds like a good academic thing.
It does, doesn't it? It's like full employment
for research. Yeah.
Full employment for economists, right?
But with this new Financial Stability Oversight Committee, where it pulls in all the agencies under one umbrella, it's gonna be interesting to see how all that all plays out.
It is, and we've already seen our clients with all of this regulation. They all struggle, and they tend to be reactive, obviously. They put
Right.
them in place right before they go into effect, as that's just being good business people.
Sure.
And they are struggling currently with the pronouncements of the CFPB.
Right. In particular, I think the thing that is causing a lot of heartburn is to understand exactly which documents they need to provide to the borrower.
At what time?
Exactly.
So where in the which documents and where in the process?
Right. I mean, it requires any document used in the valuation process of the property. But then you get into a lot of issues because in the process, in the standard technique for getting an appraisal and then reviewing that appraisal, you're often going to get 4 or 5, maybe 6 different documents with data that supports various values.
Right.
Okay, so the question is, do you have to send all of those to the borrower? Because borrower is going to be very confused by that.
They are.
Or if it's not used in the valuation process, but is used in the review process, is that okay?
Right.
You know, or if we have a product that the loan officers are using to help the borrower understand whether their proposed amount of the loan is likely to be approved up front before there's any valuation
Which is
process.
really not a value. It's for loan purposes. It is a value that's used to determine if it's going to be
if you should take the application.
feasible.
Right.
Well, and we're not trying to discourage any applications.
Right.
Just is it going to work? We're going to be able to do what you as an applicant need us to do.
Exactly. So is that something that needs to be provided? So
Well,
it's a lot of ambiguity.
Well, let's talk about guidance for our clients
Uh-huh.
and prospects out there. I think it's better to err on the side of full disclosure and transparency. So give them, when we talk to clients about this in general, our general advice is, and this is a generalization, give them everything.
Well, yeah, I think the thing they're concerned about on that is their timing elements of that.
That's true.
So if they say that this is really a document you should be providing, then you have to provide it within a certain time frame.
That's true.
And also that means that you're going to then be sending out multiple documents at different time frames with potentially different values on them. It's going to be very confusing to the borrower.
It's going to be very expensive for the lender, which
Right.
means that it's imperative to have electronic disclosures authorized right up front.
Right.
And then it is going to be confusing to the borrower. So this concept, when I was coming up, this concept of things in plain English,
Uh-huh.
there is going to have to be clear and concise disclosures developed around, and certainly they're going to have to be in conformity with CFPB guidelines.
Right.
And they're going to have to be furnished in a timely fashion. That is going to get to be a bigger and bigger deal.
Yeah. Our corporate attorney has put together a document that analyzes all of the issues around this, and this is not a legal opinion, but it basically puts some perspective on all of these issues and on the regulation. And if anybody'd like it, they're more than welcome to have a copy of it.
I'm sure we'll have it on our website, and just search on our website. We'll try to have it on Morning View's website as well as our corporate website. And the idea of all of this regulation, the idea is to put these things in the sunshine.
Right.
There's a
Right.
belief in regulatory circles that sunshine is the great disinfectant. And so if we put everything out there in the sunshine and disclose these things, that borrowers will be able to understand what is going on. I think initially they're going to be very confused.
I do too. I think it's going to be very confusing for them. It's a shame in a way that there isn't some sort of a consolidated way of delivering this information that's very simple to understand to the borrower.
Well, it comes in a disjointed process. The
Right.
mortgage process is a disjointed process.
Long process.
It
Yeah.
is. It's also very disjointed.
Right.
It's you take the application, you collect the documents, you make a decision, and there are documents being assimilated throughout that process. And so the disclosure process with certain time windows, and I think the CFPB will probably revisit that.
Yeah. Well, I don't know why DoddFrank didn't come to us and tell them how to do all this.
I thought they did. I thought they asked you.
Now,
All right.
is this your responsibility?
I guess it is. I guess it is. Well, we're out of time today. We hope you all have a fantastic week. Our next Morning View will be January the 6th. Next Monday is the Monday before Christmas, and then we have the Monday before New Year's. We're going to take 2 weeks off. We're still going to be working, but we're going to take 2 weeks hiatus in terms of Morning View, and we'll appear again on January the 6th. You all have happy holidays. Hope you have a happy new year, and we'll see you in 2014. Goodbye, Bob.
Bye.